Hello, welcome everybody. Thank you for joining me in this, I don't know, it just seemed like I just did a PUG algo meeting, but I believe that was back in April, and now this is May. Welcome to May. Sell in May, go away. Not necessarily, not necessarily. All right, what is today's meeting about? It's about a couple follow. Hello again, Bonnie. Did you tell Joe to move over there when you guys were trading the cattle futures? Is that Joe with utterly bad joke? I understand. Is that Joe with dark side of the moon underneath their name? I didn't get that. I saw that. I didn't know what that meant. The Joe from Dark Side of the Moon. Probably one of the greatest albums of all time. Top 10 at least. All right. All right. So I can't touch it. Disclosure, trading's risky, involves risk of loss. All right. So I had something I wanted to address, and it was the first question about VIX. It's very interesting, VIX versus, and I know this isn't our algo, but we have the algo programmed with the VXX. This week in the newsletter, I'm sure this just part of my work, so I can't really tell you it's all intertwined, right? So the reason we have a question about the VIX is the SPY the other day, last week, Friday, when I write this newsletter on the weekends, was up less than 0.6% for the week, whereas the VIX, the VIX index, gained 7%. It's a warning sign that we're looking for some kind of a pullback in the market. And I think I went on to say in the video that the VIX is a lot different than the VXX. And so there was, I opened my mouth. Someone asked if I would cover it a little bit, since this is a volatility, or excuse me, this is a trading PUG and we have a trading strategy on. I thought I would cover quickly about this. So I did a class on VIX versus the VXX. So let's take a look at that. And this, I think it's pretty good since we're talking about the algo, and this is an algo PUG meeting. It's good to go over this briefly. So the VXX is on the S&P 500. It's a VIX short-term. Its price structure is against the short-term futures of the VIX. And it has a daily rolling long position. And the index of the futures roll continuously throughout each month, from the first month of the VIX futures into the second month of the contract. So again, if this is May, when the May futures are untradeable, first notice day or last trading day, and we roll out of May, then we're going to roll into June. So if you think about it, June, what's the second month after June? July. All right. So that's your rolling of your months. And if we get into at the end of or in the middle of June, we roll out of the June futures, then it would be July, August. So that's what I was trying to communicate in this particular slide. What is the VXX value based on? It's based on multiple variables. The direction of the SPX, the backwardation, or in this case, contango, or it is backwardation of the forward month futures. If people feel that there might be a near-term correction, but longer term, it'll bounce back, you're not going to get a higher ranking or a higher reading in the forward month futures. And that's what the VIX is, or the VXX is suggesting. It resets price value by means of reverse splits, and it just did it. So now, by the way, if you look here, it says laser target up here in the upper right corner. Guys, we did this class, and I taught this at the beginning of this year to prepare us for this year. And what happened? Sure enough, 4 months later, April, we had a reverse 4-for-1 split in the VIX, VXX, excuse me, not the VIX. Also, what is one of the other values is based on, well, demand. If no one's really trading it or is interested, and that's kind of like a regular nomenclature. I mean, let's face it, this thing does tens of millions of volume a day. So it does have relative volume that's not going anywhere. But last week was the split, and maybe perhaps the rollover effect of people waiting for after the split. There was a light dip in volume. So the reason I wanted to bring this to your attention is, and there for an algo class, you'd be going like, well, John, what the? Let's double check something here. We had in a class we did over a summer ago, we did several classes. The first one was I developed a class called Razor Focus in January of 2020. There it is. There's the workspace. I haven't altered it. I don't believe I've changed it. I don't think I've done anything to this. Tweaked it, untweaked, not tweaked. This is the original workspace. The interesting aspect is that I also had a lot of different other models we used, especially trading in the VIX, the VXX. This was a class that I did in summer school. We called it summer school to prepare us for, it was crazy with the pandemic. And what I did is I created an updated version of the SPY model. I did a QQQ model, figuring, gee, we're going to have a we should have a wild, crazy market. And the topic right this second is the VXX and that model. This model particularly did something unique. It optimized out as scaling out of positions. And I'll share that with you in just a quick second. Oh, don't touch that, John. That's not good. Don't touch. There we go. This particular unit, it'll get out a half at the intended profit and trail the balance. This particular model took longs, as you can see, and it took shorts. So performance, by the way, where does it stand up? It's still in about 10% of its position. It got out of 90% of the position, so it's not adjusting its next new profit because it's in a current position. There's the performance, your performance summary. It's not quite a profit factor of 2 on longs or on shorts. 61% of the shorts make money, and that's the relative performance. Here's what I like to always look at. Now, this is tricky. Buy and hold return, VXX, when the stock market goes up, it defaults to always going down. In fact, it's designed to go down. So the VXX was another model to use to help, confirm bullishness or bearishness for the overall spider, as well as provide a tradable product. So as you can see, this particular model, I want everyone to understand in quick layman's terms, buy and hold, it's down 73%. So maybe you want to invert that and say sell and hold. It would be up 73 or 74%. The return on initial capital for this model, it supersedes that. Bottom line, if the market always goes down, it would be, if it's a down market and you have a short-only model, does your model beat the negative? So I'm just trying to say, let's invert that since it's defaulted to going down because the stock market's gone up. Invert that negative 73, put a positive in front of it, and the strategy still has outperformed a buy and hold. That's all I'm trying to suggest. All right. So bottom line is it's a very volatile product. It has some consistencies in its trades. And many of you are aware that in this case, red, bad, blue, good. Okay. So bottom line, in a very wild and woolly market, this thing's held its own, done pretty well. But I just wanted to provide to you what today's topic du jour is. When we come in with algos, do we need to update them, maintain them? And, one of the things that we look at is absolutely, because market conditions change, without adjusting or changing anything, right? Without any of these models, none of these were changed. We also, back in summer school last year, said the Russell should do something. And quite frankly, the Russell, this particular model on the Russell, whether you're trading the Russell or not, still is maintained. Shorts doesn't do too well. The overall performance on this, it's still trending pretty good. It's ticking away. Again, it was short. It just exited a little tiny short. Now, this is kind of a sad story because of the way the volatility is. Sad story. It was short from over here. It has a trailing stop feature, and this is a great question. That was the open. This is the stop. The market closes, it gapped higher, and then just, continue to weaken. Why is that a good story? Because I'm seeing that we have a question here, and it's from Trev. And Trev says, "Hi, John. I was wondering if a strategy takes a signal at the close. Now, in other words, it gets in on the close on TradeStation. Or maybe it gets on the close, or, better yet, a more realistic example. And maybe a better way to define or answer your question, Trev, and the answer, I'll just say yes. There's your answer. Yes, absolutely. The question is, "Hi, John. I was wondering if a strategy takes a signal at the close, have you ever bought or sold in the pre or after market?" Yes. The answer is absolutely. You got to work limit orders, though, right? Or is it best to wait until the strategy fills itself at the regular session? The regular session would be tomorrow morning's open outcry. So bottom line, today, I even said this in the live trading room. I don't know if you were there, Trev. I said, this thing's stop is going to get out a tick above that red line. And this is the trade room SPY model. If tomorrow we gap higher, so you can actually say, well, there's the stop. And since you can trade the pre-market, if you're short this trade, it gave back a lot of the profit. If it gaps higher tomorrow morning, based on whatever comments tonight, maybe Janet Yellen says, I was just joking. I meant like in 5 years from now. We don't plan on raising rates. In fact, President Biden, he was joking about capital gains tax. We're going to lower those. Let's say that happens. This market would open up maybe 2% higher on the open outcry session. So Trev, in answer to your question, not to be funny, but stranger things have happened overnight. If someone made some kind of comment that the market was very receptive to, it's going to gap higher. So if you know a strategy says, well, I've got a stop sitting here, it's going to get out a tick above the high, the next bar opens up. What if it opens up here? You're going to take a winner into a loser. Can you override that position on your platform? Answer A, yes. B, can you get out or enter in the pre-market? And it's the answer is yes, because it's trading. It's just the algo, this particular models that I programmed are only designed for open outcry. All right, bottom line. So Trev, I hope that answered your question. Number one, it was a good question, and it's relative to what I was just saying right before I came in here in the live trading room. You guys in the pre-market or post-market or in the hour market, if you're following the strategy, get out. So that's and just to let you know, what's the difference between this is the model for the live trading room. This is the live trading room page. So performance graph. That's not bad. It's still good. This is the one we run in the live trading room. We have several different models. We have a SPY model. We have the SPXL model, which just came off a new equity high. We've got futures. We've got what I did in the last meeting is I kind of went through at the last, so I would encourage you to, if you weren't here, to look at the last meeting. I dissected the SQQ. Why is this? What am I doing here, person? Here we go. The SQQ, which it's currently, this thing went long, it got out, it went short today, and there's the performance. We had two models, by the way, on GBTC, the old 16 and the new 18, or excuse me, if I may be so bold. Cancel. I'm clicking something. And if we go to studies and edit strategy, What I meant is this is version 17 V2 18. So I always call it 18. We're not renaming it. It's Algo 17. It's the second version and the 18th version of the, so it should actually be version, I forget, maybe Algo 17 update number, I don't know, 36 or something like that if we really wanted to do it. Okay. But anyway, this is the, we decided in the live trading room after having two Bitcoin GBTC Bitcoin models trading side by side, the old 16 and the new 18. And I said, okay, let's let it run for a month. Oh, let's let it 2 months. Let's let it run for the entire quarter. And then finally, I think a couple of weeks ago, I said, listen, by far, this one on average is better than the original 16, mainly because of the functionality of the compression stops. So anyway, this is the one that if you're interested in Bitcoin, I mean, that's some pretty wild trading range, which by the way, kind of resembles the S&P, doesn't it? Big wild trading range. I'll show that to you in just a second. This particular model was long. It got out right before that. And it didn't pick up on a short position, but it's current flat position. And you can see it says, well, it's flat. All right. Let's get into some questions. All right. So I just wanted to go through what are you looking at and why are we looking at it? That's number one. The point was that VIX has always been a part of my trading strategies. I've built them. We have them in the live trading room. There's certain things you've got to know. It's kind of like, I mean, it could be a great topic about continued education, right? I try to get ahead of things and let people know maybe having a class in, say, January was a little too far in advance of April. But at least people had education to know and could follow. And when they heard, oh, there's going to be a reverse split, say, yeah, we heard about that. They do that. And that's kind of cool. Last summer, I thought in a pandemic, I mean, the way my mind works, let's say a pandemic, you got drug companies, you got biotech companies. Maybe now we'll see upside out of biotech. So I built a model for XBI, a subsector ETF of the, overall market, right? I may have wanted to, instead of XBI, I probably should have looked at possibly the, what's the word? IBB, which is a different weighted, slightly different weighting of biotech. But I thought XBI would do pretty well. And as you can see in the last, month or so, it's come back from the dead. This is the performance of that system. It had a pretty significant timely drawdown. In other words, it took a long time to recover its loss. If you started to trade this system here, you're just now back to break even. That's the duration of coming back from a drawdown. And quite frankly, the biotech space hasn't really done a whole lot. So if there is volatility, listen carefully, that's what trading systems will do. If there is trading ranges, if there's trends with normal pullbacks, then a trading system's going to do good. And they also work extremely well for something called as an indicator. What would you rather have? A system that has a pretty decent historic performance. And then you could say when it goes long and you think you should go short, you may want to double think your thinking. You know what I'm saying? If a system is short and you think, well, I want to buy the dip, what I always tell people, if you've got a system that's on a roll, why would you fade it? In other words, maybe a system isn't to, as much of trading as maybe to give you the confidence or at least to help substantiate your trade ideas. So think of this for a second, because this kind of is a segue into the next question, or one of the questions that I have to answer. You don't have to trade it. You could use it as an indicator. If something is short and you think you want to buy the dip, maybe wait for the system to cover its short position, go flat, and maybe go long. The next question is this. We don't program on an algo a options market. You can't really, because of the theta, because of implied volatility, the illiquidity between bids and asks, which strike price, and this is a direct question, and I believe from Ben, can you program, no, Jose, excuse me, Jose's question. Jose's question was, can the algo do trades with options? And the answer is yes and no. Manually, you can say, well, if I'm bullish the market, I have a buy signal, and well, the last known buy signal is over here, so I have to use this one right there. If I know I have a buy signal in the marketplace, this is a pretty weak model where it has a small risk, which is the red line, and in this particular trade, a very narrow profit target. So if you'd say, well, it's getting me long at approximately 128.37, the profit target is 130. So maybe you would buy, and that this is a model where what's the holding period on this model? Is it 2 months? Is it 2 years? Is it 5 days? On average, it's probably 3 days. It's a swing trading model. Now, I'm only going since March 22nd because that's the data we have in front of us. If you look at most of the trades, whether it's the winning trade in blue or the losing trade in red, obviously red trades don't last that long, thank God, right? I mean, if you were short here, you wouldn't want to hold it all the way to infinity. If it's a winning trade, which is marked by the blue line, I mean, this is like 1 day, 2 day, and then into the 3rd day, or quite frankly, it's literally 2.5 days. But calendar days, it's 1, 2, 3 days. 1, 2, 3 days. That was the open right there. Boom, 3 days. So what's my point? If I know it's the beginning of the week and it enters a new fresh long, I could probably do, knowing that its average holding period of this particular model, let's look, 1, 2, 3, 4 days on this one. This got out 4 days on a compression, 4 calendar days, right? It got in. This is between these two lines. You can just do it real simple. This is 1 day. This is 2 days. This is 3 days. Got out today on a calendar. That's 4 days. So if 3 to 4 days is an average holding period, do I need to buy an option that expires next month and pay for extra theta, extra time? No. I can use, if it's Monday and I generate a trade, maybe at max 4 days, well, shoot, that's Thursday. I can buy a weekly option on Friday. If it's a trade that generates on a Thursday, for example, I might have to go in either the midweek options if they're offered on a weeklies, or I'm going to have to go for the end of week the next following week. So you can actually use the signals instead of trading and the actual ETF. You can trade at the money options or in the money options. Another thing we teach, if you're directionally bullish and you have a strong direct or anything, the idea is if you're under, I think, 21 days to expiration, and we used to teach this when there wasn't as much weekly option activity, but you should be in something like a 70 delta or an 80, up to 70 to 80 delta on a strike. So that's buying an in the money option. So why? Because if the market goes up, and you're right, you're going to get 70 to 80% of the net change or the directional move of the underlying. That's what your options should appreciate. So this, instead of, if you have this strategy set up, you could say, hey, it went short, and I know that if it gets up to that red line, I get out of my option. If I get short, I buy a put. I know that I got to, your rule of thumb is you're buying a 70, 80 delta, somewhere in that range. Maybe it's 72, maybe it's 78. Maybe there's no strike price and you have to go to an 82 delta. That's why it's a range. Is everyone following me so far? I don't want to keep going on. If you should, everyone have a little handle on options at this point, right? I would imagine. So if it's short-term in nature, the shorter the expiration, the higher the delta you want. So swing trade, day traders, you're not going to find, very rare to find any time an option with 100 delta. It's very rare. If it does, it's so deep in the money, you don't want that. there's no liquidity in it, so the bid and ask is going to be a problem. So what you want to do is you want to have between a 70-80 delta, it's slightly ITM in the money. It might be, in this case, it may have been a 120 call, and you're buying a 120 call when you're getting long, when the market, or maybe it's a 125 call, and you're getting in because as the market goes up, you're going to want at least that 80% of the market value appreciation tacked on to the directional move for your option value. So there's where you would benefit from an algo optimized program manually. So you have to understand a little bit about options, obviously, and maybe XBI isn't the one for you. Anyway, maybe you want to go with IBB, or you want to use maybe the leveraged ETF and just trade the directional movement of the signals. So that's how, I guess, one of the better ways. And you can say, well, listen, are the signals any good? Well, for a while there, no. I mean, it had a drawdown after a huge run up over the last few years. I can say and just squeeze in a little bit here and say, well, is there a way we can explain this? Maybe. I mean, what's going on with XBI? And as you can see, I mean, over the last, since the beginning of the year, this was like nothing going on, sideways choppy, a breakout to a new high, a failure, and a complete breakdown. So, I mean, it's nice to see that the signal went long, got out. Damn, I mean, that's a nice, if I had to, and I didn't, I wish I did, but if I had to cherry pick something, I'd say, here's an algo system that gets you in on a breakout. That's a new high breakout. Let's look at it. That's a breakout. It was long. Got out on a compression stop. Market went sideways, got right back in on the game, went up and got out, damn close to the high, reversed and went short. I don't know many people. That's not bad shooting right there, gang, to be honest with you. There is a third question from another session. I didn't ask it, and someone had asked me, hey, person, your volume indicator, can you give us an example of when it works best? If I could, when a market makes a new high, my momentum indicator, as you can see, did not make a new high. I would line, you could probably see it for yourself. On balance volume did make a new high. Thus, maybe if people were using on balance volume, they would have said, hey, it had a new high on balance volume. It broke out. It's got good confirmation. Meanwhile, my volume indicator says, no bueno. It's got a divergence. Doesn't matter because our strategy got popped out anyway on a long position. So, I mean, is there reasonable value in this work and using algos in your trading? And I think the answer is emphatically yes. Whether you do it automatically, whether you use, and I want to make sure I mention this. I do it every class I've ever done. More times than not, I don't have the statistics on it, but more times than not, when my strategy gets in long or short, you generally have an opportunity to piggyback that trade, not only at the price, but sometimes at a better price. And a lot of times you might take some heat and you can get into the trade when it finally proves itself. Like in this case, it goes long here, nothing happened. You could have gotten in better here, better there, better here, waited and gotten in on the open the next day, right? So, I mean, I'm just pointing out a lot of good things or important things, not good things, but I'm pointing out imperative things that will help you become a better trader with this algo program. So whether it's biotech, whether it's the Qs, whether it's the spiders, if you're trading in the market, the algos might be just not as important as a great entry and exit strategy, but also as an indicator strategy as well. And I think when we did this class, at least the summer school class, gang, I mean, my logic was spiders, of course, the Qs, again, volatility because it's tradable with the VXX, And again, the Russell, because, well, it was the Russell. I mean, so we had 3 of the top stock indices. And for God's sakes, we're in a pandemic. So why don't we throw in a biotech ETF and go for there? So the question is, can the algo do trades with options? And the answer is, you really can't do the algo on an option because there's not a lot of there's no historic data on a call or a put, right? I mean, there might be a little bit, but between the bids and the ask, it's tough. Now you can, on Thinkorswim, you can actually chart an option, and it's just like ... You can chart the option price because they have a trade here and there, for example, but it's tough. You need, in order to run a strategy, you have to have, at the very least, something that there's data and then something that you can back test. So what's a better way of doing it? The market that you want to trade, like, for example, if you're interested in biotech, is you can get backdated information. You got plenty of data, and that's what you can utilize, and then apply the strategy to a strike price using the directional techniques I just mentioned with the correct delta, the high delta, for example. Can the algo do intraday? And the answer there is, well, this is an intraday. It's a 60-minute deal, okay? How can the algo help me doing better entries, exits? I think, for one, you got an idea of where the first exit strategy with the blue line by having the lines. And just to give you an example, go up here to studies. Let's go to edit strategy. Let's go to customize. And I'm going to scroll all the way to the bottom. And it says draw lines. It's 1 is true, 0 is false. If you want no lines on your chart, hit 0 and hit OK. And eventually, when I refresh and hit close, which is on a different window over here, which you guys can't see, there it is. We'll bring it into space, hit close. All the profit loss lines and the trailing stop lines went away. The only lines that are left up here, these little yellow lines, are the last conditional change lines. And I can turn that indicator off as well. So bottom line is, I believe, me personally, I like the lines. I like to know where's my stop level, where's the profit target that I can see visually. And if you're trading an option, or you want to use, instead of in lieu of the actual index, go with the option. And that's the only way that I think you don't have a real, at times, a great chance is when it pops in on an open and the market goes straight up. And here's another, I guess I want to not cherry pick, but just kind of dissect something for you. I just said that sometimes the market gets in and you got a chance to get in or better. Well, the market opened, got in on the open, got out on a loser, got in on an open, and market went down and then went back up. So here's another example of where you could have easily gotten, if you're watching this, and a 60-minute, so you got more than 4 nanoseconds to react to a trade. You got time to get in, load your dome. If you know you're watching XBI, you could easily put up, maybe we could convert this to the IBB, which is a little bit better with options, and or change it up to a leverage ETF. Okay, Jocelyn. Oh, you know what? I think I'm answering your questions, Joe, from the last session that we didn't answer from Tuesday, April 20th. Well, there it is. Okay, so you thought I didn't love you. You thought I was rejecting you. You thought, no, we ran out of time, man. But, you know, and you thought maybe we don't print this stuff out. It's all there, baby. We sure do. All right, so I hope those answered some of your questions. And as far as your last question, Q4, how can I set up, run your own scans? Well, I don't think you can. We have the program for that, and we built it in with our program, our product, okay? anyway, I thought those were some really good questions, by the way, and I appreciate it. I didn't know you were here, so thank you very much. Can I suggest that we've completed this series of questions? You're a 15% intraday, 85% stock swing trader, and then buying directional, not futures. No problem. These aren't futures. That's Spider, that's Qs, that's ETFs. These are intraday. Razor Focus is an end-of-day model. It's been long since, I think I just goofed. Oh, Lord, what did I just do? You dummy. Where's the old... You know, one click of a mouse, even for myself, I can always find myself doing stupid things. Bear with me a second. All right. So this has been long, as we can see, from about March 23rd. Let's go. Uh-oh, data disconnected. That's not, well, we don't need no stinking data right now. We have questions, we got education, and we're going to move forward. So on 329, the strategy went long. You could have gone long the next day, a better entry. You could have waited for confirmation for the thing to blow up. You got where your stop is. This is the orange where the trailing stop is. That was the intended profit. This one does not get out at the intended profit. It trails a stop. These little light gray lines, they are the trailing stop function. And today it almost clipped out at the low. It missed it by, as you can see, if I zoom it up for you. Well, it wasn't quite the exact low, but we had the stop was in play at 411.20. The low of the day was 411.67. Wow. So it's interesting sometimes the reactions and the reality of markets of support, resistance, and trailing stop functions. Anyway, that's end of day. Just I think by now you've got your answered question. Here's another interesting thing. This was a famous razor model. Why is it famous? Because this is a gift that's kept on ticking. That's the equity curve. It just popped out of by a max bar before the last on a trailing stop. The short only got out this morning. A couple of things that I actually do. I mean, when you're short the market and you have a short, took a little heat. Some of you know that Friday in the actual live trading room, as well as in our advisory service, this was partly one of the reasons why I went with a short-term put spread for, if you noticed, May 14th expiration, because I was looking for a market it was short on the system, not just the short only, but also the long and short model on the Razor Focus. I mean, that's got a pretty decent track record. It's got a pretty decent performance. I'm sure you could see that it's green. It's got a nice 45-degree angle. It's not parabolic. It's not one trade that took it up. It's been trading. And so I went with a short-term option strategy, close to the money. I mean, I probably should have done a little bit better job, but I went with the 415, 410, thinking it would be within the realm of reality or take the bulk of the profit. I actually did what we talked about today in real life, guys. All right. So there's your another reasonable way of trading the market. And if it's something that gets out of a trade, what do you want to do? Hang on with it, right? If you're near an area that you start to see other examples. And then today I said, by chance, if the advanced decline, you could see the post in the live trading room. If we got back above, what was that? What did I say? 230 by 350, which is the last 10 minutes of the day, come out of all the spreads. End of story. And that's what we did. Where the market could chop around a little bit? Sure. Could do a lot of things. But here's the deal. If you got two models that are pretty decent and they're now flat, why are you short? If they're short, why are you long? So again, they're great indicators. Trev, we got your question. Joe, I'm getting rid of your question. I'm just saying I think we did a good job there taking care of that. Let's see here. All right, Ben had asked a question in regards to options, and I got to tell you, Ben, I may have, and I hope I didn't. If you're listening, if you're here today, Ben's in Canada, which means he's in no, wait a minute. He's in Torino, Italy. I thought I saw you were in Canada. But Ben is in Torino on another COVID red lockdown. I would think, yeah, right. Thankfully, I am virus-free as of this email. Well, God bless, and I hope you remain that way. So it's kind of a question. I'm not going to go through the detail because it's not anything to do with, it's an option question. It's got nothing to do with algo, but I will give you the answer. You were trading a stock. You like to sell an in-the-money put. You're long the stock at 50. You sold the 55 put. Granted, you received $6.50 for the put, $5 of intrinsic value, $1.50 of, again, theta, time, as well as implied volatility. And that's the one thing that you did not equate with. If the stock goes up too far too fast, there's still a shot the stock could come down. If implied volatility rises, options are more expensive. So a lot of times, that's why people, they get into an option, even despite the fact that it's valued right. It's one of our classes that we have given and we remain true to, as I was taught 40 years ago. Implied volatility is everything. If implied volatility relative to 52-week historic and implied is high, you're paying too much for premiums. You could be right in the market. It could go up, but because you paid too much, your option's not going to go up in value if you're directionally long. Inversely, if you shorted the put and you as a covered a right strategy and you're long the stock looking for a double zing on upside movement, well, you're not going to get as much as the option. If it happened too quickly, it's not going to have any theta decay. And number two, if it happened too quickly, the rate of change of price is too great, too fast, too soon, implied volatility rises, and the options are overinflated. So you're not going to see the devaluation by selling the put, even when the market went up in your way. That's all about that, Ben. It's called implied volatility and volatility. And I think I skipped over your question. I said, well, because I was kind of in a hurry on the last PUG meeting, and I said, this is an option question. It's not the thing, but when someone sends the time to type something up, I should have, and I just want you to know, I didn't throw that question away. So you sent that on Saturday, April 10th. So I do take concern for my clients. And if you took the time to actually type this up and have that question for us, then I should have the decency to at least address it a little bit, right? That's my 2 cents. Thank you for your time. And I hope that was the right answer, by the way, of what happened there, Ben. It was the implied volatility. You're not taking the IV into consideration when you're selling or when you're doing an option strategy. All right. Hamdi said, thanks for an informative session. He's been playing. I set him up with a prototype model of the Qs. I don't mind sharing the summer school model a little bit. I mean, this is, I got to tell you, one of the most dynamic markets in, choppy history that we see with wide range movements. Not really, big breakout in trending. It's overnight action. And on buys and sells, it misses a little bit of it stopped out on a compression stop. It opens lower, it trades higher. This is not your I mean, this is not a really smooth, consistent market. This is kind of a scary market. Gaps up, next day jams it right back down again. Up again, down again, up and down. I mean, talk about headache environment. This is the cues, right? So the question is, he's been playing with a model. Obviously this was April 16th. This was over here. Since April 16th, if the model's any closer to what we got, it's done a pretty damn good job, except for that doohickey right there. It went short. And Trev, this might be a very good question for you. See that overnight risk action? That's the overnight upside. It opened on the high. There's your stop. It got out. It did what it's supposed to do. The question is, maybe there was an earnings. Maybe and I think that was probably an earnings event. That was it Google? Was it Amazon? I mean, if you're short the market and you're in a profit and you're giving your profit back up and you're almost back to like break even. The point is, yeah, your stops. Can you get out in the pre-market before you get like slammed in your face? And you can make that override judgment. And the answer is absolutely, Trev. There's a great example of why would you not want to take advantage when you can by offsetting your position. The only thing you can't offset is obviously the options, right? So just like in today's session, where the market has a stop that I shared with you from the, here we go. I mean, that's so close to the stop, and the profit got narrowly cut down. I mean, literally, the profit is down to next to nothing already, okay? Why the heck would you, if the market gaps higher tomorrow, all your profit, you're going to turn a winner into a loser. So when you come to a situation and you're watching your strategy, yes, by all means, get out in the pre-market or the post-market or the after-hour market. That's what it's for. But you may have to chase it by selling the bid and on limit orders, right? And work that for a little while. Anyway, I think we've gotten a lot of the older questions out of the way, number one. And then, I'm generally one that we do a lot of, I guess you would have to say, some of you guys are all here with customer service appreciation, but we have continued education. And some people have been asking, hey, when are we going to do another class? And the answer is we are going to conduct a class at the end of May, by the way, on updating and modifying, or when you would want to maintain, is my word, I like to say, maintain trading systems. So for those interested, I think we have an interesting scenario that's going on. One of the main things when everyone has ever taken one of my classes, and by the way, again, I keep referring to practice what you preach. So one of the things that we preach is this little doohickey right up here. It's called average true range. I don't keep it there because it's a pretty color purple. I keep it there to define what is not just the ES 5-minute model doing or the conditions in the ES, but we also have ATR right here. So let's take a look at futures long-term real quick and just take a look at ES. We're now ES at 41 handles. It's easy for me to use the ES at 41 handles as an express monetary movement more so than, say, the spider. But this is for the daily, and versus the range today, by the way, was 65 handles. Okay, 65, what's a handle? All right, so I think someone asked me, what the hell is a handle? So 4158.25. 41, there's 4 ticks in the future to 1 point. So a handle would be, what is the full digit? So we're at a quarter. Well, what's the handle? It's 58. We could be at 56. We could have been at 54. We could have been at 77 5 minutes ago. You don't know what the handle is. Are you, the little ticks and the decimal point, that's irrelevant. What's the main number? We're trading at 58, the handle. What's the handle? 58. So if we go from 58 to 68, that's a 10 handle, 10-point move, not the decimal. That's just the nomenclature. So I tend to bring my old experience. I don't know how long ago. It wasn't much other than I said something like double nickel at a meeting, and someone goes, "What the hell's a double nickel?" And I said, "Think about it. 2 times 2 fives is 2 nickels. 5's a nickel, double nickel." Anyway, it's not like I'm talking about 1904 and talking about a double sawbuck, but double nickel was a nomenclature or the terminology for just saying 55. It was a little easier and snazzier to say double nickel. And what's the handle is another trader's nomenclature to say where's the market at, right? I know it's at a quarter numbnut. Where's the market though? I don't know. Where's the handle? What's the handle? Are we at 54 or 74? That's a big difference. That's 20 S&P points. It's $1,000, right? All right. So anyway, now that I got that out of my system, we've had about, I think it was from 2013 to 2018, on average, a 29-point ATR in the marketplace. Fast forward, we had exit stage left, Janet Yellen, who comes in, our boy Jerome Powell. In December of 2018, Jerome Powell decides to raise interest rates. If you recall that, 2018. So in 2018, and here's 2018, we went through a 10-day period ATR that expressly, here's December right there. It was right after the midterm elections in November. Then December right there, that turned into a 10-day ATR of I think it was like 89 points. Where am I going with this? When markets start to move down, they move down a lot further and faster, and ATR rises. We went through from a period, and if you look at these monthly bars, look at each monthly range. Here's 2013. Here's the crash. I mean, you remember the crash in 09, which was really, really wild? I mean, literally the big crash in 2008 when we were selling off, I mean, it's still a muted move compared to normal monthly bars to the upside. Right now, we have wider ranges now than we did in a crash back in 2008. Throughout history, things change. On average, though, leading up to that crash, look at the monthly ranges. It was nothing. So you could have bigger positions. You had to have maybe higher time frame holding periods. Okay? Fast forward. Now we get into this thing. That was December. Then we got the pandemic. We went through, I believe in March, we had a 10-day ATR reading of 240. I'm going to say 249. I think it was 248 point something. So let's just say 250. So for practical purposes, in December, in a 10-day average true range, which means the S&Ps were 90 points. People were freaking out because it's really tough to manage your risk and your position size, knowing you're in a free fall and your daily ranges over a 10-day span increased to 90 S&P points. That's brutal. Fast forward, if you think that's brutal, how about this period in time where it went to 250 or 248 and change, actually? So the point is that at times we're going to have to, you can't trade a system that's now with the market trading, well, 1% move at 4,000 S&P value is a lot different than a 1% move just simply 7-8 years ago when the market was, well, less than half. Okay. I mean, literally you got to have now we've got a different in percent terms. A 1% move today is like a 2% move back then. So when you say there's a 2% correction, whoa, baby, that's a big move. So for an algo strategist trading E-mini S&Ps or trading the spider, we're going to have to maintain and identify, hey, baby, you got to start looking at you can't do a back dated or a back test study that says, hey, I got 20 years. What was the market environment here How is it compared to a market environment here? It's two different worlds. Okay, the trend is up, and I get it, and the trend is up. Okay, I get it. But when there's a bad month, it's bad. When there's a bad month, I mean, this month pullback, just to give an example, July of 2014 had a range of, what was that, like 63 points? Shit, we did 63 points today. Gosh almighty. 63 points today. We did a 63-point pullback back then for the month. We do it on an average day. How can you build a system and say, look at my beautiful backtest study, and I had it all figured out way back then based on this long-term history, and I got a great performance? No, you don't see any of my stuff much beyond 2019 because that's the era of volatility, and that's what we're in. So again, there will be a time that eventually, my guess is, we are going to enter from a period of excessive volatility. We're going to go through a period of digesting said volatility. You know, trend, consolidation, trend, then a consolidation. It should last with this type of an upside. My guess is maybe 2, 3, at least 3 months. By the way, when this thing broke out and paused, 1, 2, 3, 4, 5 months later, those are 5 bars right there. It went sideways for 5 bars first, then down. Again, it broke out 1, 2, 3, 4, 5th month down. I'm not saying 5 is a magical number, but after strong uptrends, we go through periods of consolidation. And I think that's one of the things that we need to face with right now is a period of a consolidation or adjustment period. And that's where I think it's important that anyone that is trading the system, don't forget you have to look backwards, but you also have to look forward. And when I say you have to look forward, I don't mean by forward optimization. What I mean is you have to look forward and say, what is the market condition? Can we continue on this toward pace and this type of monthly type of ranges without some kind of a pause when people say, all right, enough's enough? And I think today with Janet Yellen, it may have been her way of saying, all right, guys, calm down. And as you notice, Bitcoin didn't respond well. The precious metals didn't. There's a lot of things that backed off. So I think it's important and it's imperative that we do a couple things, and so that we do have a better success of trading. We do make money more consistently, and we're not caught off guard. And that's what's really powerful. And I mean, it's going to be very nice to have that type of, what's important for me is to get the right information in a timely manner. I don't want to hear what did, look what did move. They're all talking about, hey, the market just went down today. Maybe we should buy puts. Wait a minute. We came out of our puts today. Wouldn't you want to have had said before the market went down and have better information and say, maybe we should have bought some puts last week because now it's a little late? I mean, the NASDAQ down 268 points. The S&Ps at one point were, we were down, almost 60 handles today, 60 points. And you want to start buying puts today? I don't know about that. So with our class, with my model and with the structure, or at least the way I think, and I like to give people a better shot and at least learn more and learn the right things and give it at least so that you have a more than fighting chance. You have a winning chance, that you stay on the winning side. That's my 2 cents. So with that said, we are going to have a new class at the end of May. If you're interested for those for continued education, we will have it. I just posted it online. You can go to this website and see what we're going to do. We're going to take the razor focus model for those that had it. So first off, you have to have it. But if you want, and you want to go through the optimization process, this is what we're going to be doing, because I think the SPY is going to be, we're going to need to do this. And we're going to go through the entire optimization process, top to bottom, and build those strategies. And that's what the intention is. So you can go visit that website or at least that landing page and check it out. And for those that don't have the razor focus that want it, there's a way to look at that as well. Razor focus, maybe I should name it something else. It was the name of the workshop It was just, I wanted everyone to be razor focused on 2020. This is before I knew we were going to be in a pandemic. This was the model. I thought, hey, let's have an end of day for those who want an end of day spider. Let's have, since the market generally goes up, in equities 80% of the time, let's just do a long only model. For those times that we might come through a correction, let's have a short only, and then let's have let's do both, and we'll break it down. And that's exactly what we did here with the long only, the short only, and the long and short. And I've already shown you there's the current performance of something that we did way back, and I have to say it was probably somewhere right about there, January of 2020, and that's that performance of that model. So I think our time today, by the way, this model razor focus, I constantly, or at least times, I tell people, hey, the razor focus, you hear me say that in the live trading room. And this is the one, if the razor focus is out, I generally tend to tell people, I don't give this strategy out. We don't sell this strategy on the open market. It was a class I gave, and out of the courtesy of those that attended it, I said, we're not going to bastardize it. We're not selling this. This is for people that took the class. But that's why I said, if you never took that class or you're new to us and you want to, the class is available online. Read up, study up. We're going to work on these, and we're going to re-optimize these from start to finish. And we're going to do it over a period of 3 nights. And that's going to be on, if I'm not mistaken, I think I just X'd it out. It's May 26th. Through the 25th through the 27th. It's on the website if those are interested. I thank you for your time. I hope I answered your question. Trev, thanks for starting us off. Ben, I felt bad that I kind of, I just went up. It's options. Doesn't matter. Hamdi, I hope your prototype model should be doing well. Hamdi might not be joining us live right now. I'm sure he'll be reviewing this. And for everyone else, have a great evening. Thank you for joining me. That concludes our time. I did push the link so that you can check it out if you're interested in that. And it'll be right before Memorial Day, because I know nobody wants to go out and party on Memorial Day. They're going to want to all stay in after taking this class and study up on a 3-day holiday. Thanks, everybody. I'm joking. Have a great rest of your evening. Thank you.